Restructuring my business finances can help my business. Tonight, as we finally look out, coming out of lockdown, it's important we review our businesses, their finance needs, and the opportunity to grow our businesses. At Projects RH, we have been working with our clients over the last few months to ensure that they have their business plans and accounts ready to expand their business. Each morning, I'm amazed to see how low interest rates appear to be. And as I read of the generosity of government in supporting schemes, by mid-morning I'm realising that businesses have been unable to secure these low-cost financings and don't qualify for government largesse. I would like to share with you a conversation today with our strategic business partner on debt matters, Barry Watkins, of Clever Financial Solutions. Ladies and gentlemen, hello. My name is Paul Raftery and I am the CEO of Projects RH based in Sydney. And today I am joined by Barry Watkins, founder and director of Clever Financial Solutions based in Sydney. Barry has been a finance broker since 2008 and his skills, clear thinking, and works outside the box. His expertise lies in helping people with unique situations with a focus on investment in property and businesses. The reason I enjoy working with Barry is he brings a positive approach to even the most difficult of assignments. Barry is a good listener. He understands the markets and the different players and what they can and, more importantly, cannot do. He is frank, truthful, and he will tell me when no is required. Barry is a holder of accreditation under an Australian credit licence. Barry, we have discussed over several months a few of my clients who have been looking to refinance and or expand their financial facilities. What we are seeking from our clients is that their credit lines are being eaten up by clients paying slowly and trade finance taking far longer than it traditionally has for the goods to arrive in Australia due to shipping issues and the lack of availability of containers. I keep reading about low interest rates and the government promising that money is available, so we have a lot to discuss. Welcome, Barry.
My pleasure to be here, Paul.
Barry, the first important question is, have interest rates really fallen across the market, or is it only for the big end of town?
No, interest rates have fallen, and there's been a lot of support in that from the government and the RBA to support a flow of credit during the COVID crisis that we're in.
Barry, a number of my clients are having a really hard time during the lockdown. And we have seen a number of our clients in Victoria who have suffered heavily from the 220 days of lockdown last year and more this year. First, they are worried about the availability of money from banks and other providers that seem to have been corrected. Has that been corrected by the SME Recovery Loan Scheme? Can you please comment on the availability of money as loan from banks and plus other providers seem to be covered by the Treasurer scheme? What do you see coming out of the markets?
So the SME Recovery Scheme is 80% guaranteed by the government. So they're the ones taking the majority of the risk. That's allowed the lenders to be a bit more flexible with their normal criteria and who they would lend to, because they're not taking on as much risk. And for example, the Commonwealth Bank only a few days ago announced that they had funded some 20,000 small to medium businesses with over 1.98 billion thanks to the scheme.
Wow. Barry, on the 31st of August, Accountants Daily suggested that the biggest problem facing medium and small business was cash flow, and that this can be mitigated by increasing loans. I must admit I'm not a very big fan of more debt, as it costs money and there's no new income to cover it. It's a bit like telling companies that they should accept Afterpay and getting a sale at a discount should reduce their problems. But do they provide cash immediately? Are you seeing any way to break the cycle, and more importantly, other lenders helping to break the cycle? Importantly, are these growing age trial balances causing concern to existing lenders and making them reduce the cash available by reducing overdrafts and other credit lines?
The COVID restrictions in many states are causing cash flow problems for businesses. I agree it's not normally something to recommend to take on more debt, but these aren't normal times. I guess you really got to look at, is there light at the end of the tunnel in the restrictions? Is there going to be a time where the income will come back and start to pay some of that debt back? There are government grants available out there, but I couldn't say they're anything like what we saw initially with the pandemic response in 2020. Mm-hmm. But we have seen many listed companies on exchanges have done capital raisings to keep themselves going. So lenders have been okay to give support during the COVID restrictions. It's more going to be, is there a point where they see once the restrictions lift, if the income isn't starting to flow again, I guess there's got to be a tipping point where lenders are going to do their reviews and are going to think, well, the business can't demonstrate a way out, so will they therefore withdraw or want some of their facility paid down?
Okay. Barry, is the available debt coming from banks or non-banks? Do you think the fintech lenders will continue to have funds to lend, and do they have the volumes of money that businesses needs?
There is support for both the banks and non-banks, and that's coming from government and general money markets. For example, Get Capital, which is a non-bank, just announced today that they'd received $87 million in additional funding to support the growth of small to medium business.
But is an organisation like Get Capital funding at a similar price to a bank?
Get Capital is probably a little bit more because generally most of their stuff is unsecured.
Okay.
Whereas a bank much prefers to have security over real estate or business.
Okay, thanks, Barry. Several of our clients are telling me that they need to increase their inventories because of extended shipping times and the unavailability of containers. Now, I think the general thing is if you don't have it in stock, you can't sell it. And traditional just-in-time supplies aren't working for them or anyone anymore. Are there smarter ways at the moment to fund increased inventories?
We have seen a lot of people or businesses talk about the stretched timeframes with supply chains. Deliveries are taking longer to get here if you can even get it on a ship. And the cost of actually getting it onto a ship is, I think it's threefold compared to what it had been in the past. A lot of people are just funding those purchases out of working capital, which could be stretching their working capital. So there is the option to consider something like trade finance, where a financier is funding the purchase of those goods, and you as the business are just paying a small amount of interest to have access, but at least it's not chewing up all your working capital.
Okay. Barry, in the current world, I would now suggest we're probably a year behind the United States in how we'll recover financially from COVID. What we're seeing in the US suggests that some loans are available, but financing options have also grown. Is the way how we are going to finance change after COVID disappears? And are the banks going to be the right place and price for new loans?
I I mean, over the last few years, we have seen a steady growth in financiers in the business lending space. This has been fueled partly by businesses being more educated about products that are available out there to finance their business, and also some of those traditional products being more flexible, like invoice financing, where in the past you had to finance the whole book, where some of them are now being selective about the invoice that you can finance. I think the way that we finance will continue to change. From my own experience, I know I applied for an overdraft with 2 banks and was unsuccessful, but I was successful with a non-bank with a comparative or comparable interest rate. So things will change.
Okay. Barry, on the 21st of August, the Treasurer announced the SME loan scheme. And what he effectively said was the Commonwealth would guarantee 80% of loans made by banks. But he didn't provide the banks with any more money, and he still left them 20% exposed to any loss. Nor did he give any guidance to the banks how he expected to see these loans priced. Was this anything more than political grandstanding? Is there something really in this for business?
There is. The main change that they did was the eligibility criteria for those loans. So previously you had to have received a JobKeeper payment in the latest round of JobKeeper, which I think ended in March or something. If you hadn't received a JobKeeper payment in that, you weren't eligible to apply under the SME COVID recovery loans.
Yeah.
Now they've opened it up to anybody can apply. The program does also have a cap on the interest rate that the providers can charge. So they do have a certain limit that they can go to for interest on those loans, which is quite low for some of them.
Okay. Well, that's good to know, Barry. One of the things the Treasurer said that this facility could be used to refinance existing loans. Is that realistic? And should we be advising our clients that this will bring down their cost of money and they should be refinancing?
Potentially, yes, that was one of the changes they made. Under the previous schemes, you weren't supposed to refinance existing business debt using the COVID recovery loans, but on this one they've allowed that. But I guess it really depends on, your existing facility is how expensive is it? What's it going to take to refinance? There's the time involved in the business owner doing all the work involved in refinancing, and there's also costs involved in refinancing. So if your loan's not that much different or your rate's not that much higher and you're happy with what you've got, then maybe not. But if you're on a very expensive product, then yeah, definitely consider refinancing under the COVID SME scheme.
Thank you, Barry. Barry, back in October 2009, CPA Australia and the Australian Bankers Association produced a joint fact sheet known as Refinancing Your Business Debt. I wish I could say I remember it from university, but I don't. But what it does say is these are the fundamentals we need to use, and I do keep it handy for that point of view. This handy checklist says that we need to have our clients organised and ready to go. 2 matters that they focused on is the loan-to-value ratio and the interest cover and capacity to repay of loans, rather than just seeing debt being rolled. Is one of the key things we need to ask ourselves when working with our clients about refinancing is it increasing their level of debt and can they repay it? Under the current interest rate environment, should the businesses be looking to refinance?
The fundamentals still apply in lending. So if it is secured by property, loan-to-value ratio will apply. The banks are always going to look at debt servicing ratios to make sure that the business can afford to make the repayments. It's no use lending someone money if they can't afford to make repayments. Liquidity ratios such as net equity and debt to equity play a part to make sure the business is not too overly leveraged. Mm-hmm. But they're also still looking at experience of the management team and the industry that the business operates in. Some of the newer forms of lending, I guess, they just take a snapshot of your business revenue for the last 12 months and decide off of that how much they're willing to lend you. They generally do a percentage of the amount, but then they're also looking at your credit record to see, or the business's credit record to see what other facilities may still be there. So the primary fundamentals still exist, and it's worthwhile, taking that into account.
Barry, for businesses that aren't experiencing cash flow difficulties, is now a time to look at refinancing? Any time's a good time to look at refinancing if there's going to be a benefit to the business. If there's no cash flow problems, then the business can grow with what it's got, then that's all well and good. But if they're low, there's plenty of competition out there in the market. You just have to weigh up, the costs and the time involved in doing that refinancing. Barry, thank you for your insight into the world of business finance. We would like to thank you for your time tonight.
My pleasure, Paul. Good night, ladies and gentlemen.
My name is Paul Raftery, and I am the CEO of Projects RH, based in Sydney. And today I have been with Barry Watkins, the founder of and director of Clever Finance Solutions, a leading business loan advisor. He is also based in Sydney. Ladies and gentlemen, goodbye for now.